Nadia buys a house. Derek keeps renting and invests the difference. They both think the other one is making a mistake. And in 2026, with mortgage rates above 6%, a median home price pushing past $400,000, and rent averaging nearly $2,000 a month, neither of them has an obvious answer. But when you actually run every number over 10 years, not the ones on the billboard, the real ones, one of them comes out ahead. And it's not who you think. Let's set the stage. Nadia and Derek are both 30, both earning $75,000 a year, both living in the same mid-sized city. They've each saved $60,000. Same starting point, same cost of living. The only difference is what they do next. Nadia uses her $60,000 as a 15% down payment on a $400,000 house. She takes out a 30-year fixed mortgage at 6.2%. Her monthly mortgage payment lands around $2,090. Add property taxes, insurance, and PMI, and she's paying roughly $2,750 a month to live in her home. It stings, but she tells herself she's building equity. She's investing in her future. Derek signs a lease for a comparable place at $1,800 a month. He takes the $950 difference between what Nadia pays and what he pays and drops it into a total stock market index fund every single month. He also puts his $60,000 in the same fund on day one. No leverage, no lawn to mow, no closing costs. He sets it and forgets it. On move-in day, Nadia has a house, a set of keys, and a front yard. Derek has a brokerage account and a direct deposit he doesn't think about. Nobody at the housewarming party asks Derek about his portfolio. Year one feels like a blowout in Nadia's favour. She's decorating her living room. She's painting the bedroom whatever colour she wants. She's telling people, I own my home, with a confidence that hits different than saying, I rent. Every mortgage payment feels like progress, and technically it is. A small slice of each payment chips away at her principal. Her home might appreciate 2 to 3% this year. She's already seeing neighbours sell for more than they paid. Derek, meanwhile, is watching a number on a screen go up a few percent. He checks it once a quarter. Some months it goes down. There's no key in his pocket, no front yard to stand in, no asset he can point to from the sidewalk. When friends ask what he's investing in, he says index funds, and nobody asks a follow-up question. But let's open the books. By year 3, Nadia has paid approximately $99,000 in mortgage payments. Of that, roughly $62,000 went straight to interest. Gone. Not building equity, not coming back. Another $10,800 went to property taxes. Insurance cost her about $5,400. She replaced the water heater for $1,300, fixed a drainage issue for $2,200, and spent $4,500 on maintenance and small repairs she didn't see coming. Closing costs on the original purchase ate $12,000 that she'll never recover unless she stays long enough for appreciation to cover it. Her home is now worth maybe $425,000. Her remaining mortgage balance is around $323,000. That puts her equity at roughly $102,000, $60,000 of which is just her original down payment coming back to her. Her real equity gain from appreciation and principal paydown is somewhere around $42,000. Not bad. But it cost her a lot more than people realize to get there. Derek has his original $60,000 plus 3 years of investing $950 a month. At a roughly 10% average annual return, his portfolio sits at about $118,000. He put in $94,200 total. The rest is compound growth. He didn't fix a single pipe. He didn't call a single contractor. He didn't spend a single Saturday at a hardware store. At year 3, Derek is actually ahead in liquid net wealth, and nobody saw that coming, least of all Nadia. Here's what the building equity crowd never talks about. In the early years of a mortgage at 6.2%, you're barely building equity at all. Almost 70% of your payment goes to interest in year 1. You're essentially renting money from the bank, and the bank is keeping most of what you send. The equity story gets better over time, but it takes 7 to 10 years before the math starts shifting meaningfully in the homeowner's favour. And the hidden costs keep stacking. The general rule is 1 to 2% of your home's value per year in maintenance. On a $400,000 house, that's $4,000 to $8,000 annually. Some years it's a $150 clogged drain. Other years it's a $9,000 roof repair that can't wait. Property taxes go up, insurance premiums go up, and if Nadia ever wants to sell, she's paying 5 to 6% in transaction costs. On a $450,000 sale, that's $22,000 to $27,000. Vanished. Now fast forward to year 10. Nadia's house is worth roughly $490,000 to $520,000, assuming 2 to 3% annual appreciation. Her mortgage balance has dropped to around $280,000. Her equity is somewhere between $210,000 and $240,000. Over 10 years after subtracting all real costs, interest, taxes, insurance, maintenance, repairs, and closing costs, her net gain from home ownership is roughly $100,000 to $130,000 above what she put in. Derek has been investing $950 a month for 10 years on top of his $60,000 starting balance. At 10% average annual returns, his portfolio is sitting at approximately $280,000 to $310,000. He invested $174,000 total. The rest is pure compounding. No debt, no closing costs, no emergency repair fund, no anxiety about whether the housing market dipped. At year 10, Derek is ahead, not by a staggering amount, but he's ahead. And he spent a decade doing absolutely nothing to get there. But here's where I have to be honest about what Derek gave up. He has no hedge against rising rents. If his rent goes up 3% a year, he's paying over $2,400 a month by year 10. Nadia's mortgage payment never changed. He has no leverage. Nadia used $60,000 to control a $400,000 asset. Derek used $60,000 to control $60,000 in assets. When the house goes up in value, Nadia's return on her down payment is amplified. Derek's returns are only on what he actually invested. And there's a psychological cost nobody puts on a spreadsheet. Derek has no stability guarantee. His landlord can sell the building. His lease can end. He can be forced to move with 60 days' notice. Nadia never has to think about that. Her housing cost is locked. Her home is hers. That peace of mind is worth something, even if it doesn't show up in a brokerage statement. Home ownership wins in specific identifiable situations. If you're staying more than 7 years, if you're in a market where prices are still undervalued relative to rents, if you can put 20% down and avoid PMI, if you treat maintenance as a real line item, not a surprise, and if you value the stability of a fixed housing cost in an environment where rents keep climbing 2 to 3% a year. Renting and investing wins if you're mobile, if your local market is overpriced, if you actually invest the difference every single month and don't touch it, and if you can stomach watching your net worth drop 30% during a crash without panic selling. That last part isn't hypothetical. Most retail investors can't do it. Nadia and Derek both made reasonable choices. But the one who comes out richer isn't the one who picked the right asset. It's the one who actually ran the full numbers. Every hidden cost, every opportunity cost, every hour spent, every dollar that disappeared along the way. And made the choice that fit their life, not someone else's headline. So the next time someone tells you renting is throwing money away, or that buying is always the smart move, ask them one question. Did you include everything? Because in 2026, the gap between the headline math and the real math is wider than it's ever been. And the only answer that matters is the one that includes everything.